The calendar has flipped, but markets are still grappling with the same big issues they faced in 2011, a sluggish U.S. economy and a debt crisis in Europe that threatens growth both here and around the globe. We've selected a handful of funds that should help investors prosper in this difficult environment. First, stock mutual funds. Consider FPA Crescent and the Sequoia Fund. FPA Crescent is just the type of fund you want in uncertain times. It generally invests in blue chips, and while it won't offer gangbuster returns in bull markets, it cushions portfolios during downturns. The Sequoia Fund invests in large companies that boast strong balance sheets. Over the past decade, the fund has beaten the S&P 500 index by an average of 3 percentage points a year, yet it's been 14% less volatile than the index. On to bond funds. Look to intermediate-term bond funds for the greatest growth potential and the least risk of loss in the off-chance interest rates spike. Vanguard Intermediate-Term Tax-Exempt Bond Fund is a good middle-of-the-road option. The fund invests almost entirely in bonds rated single A or better, and it distributes tax-free interest at an annual rate of 3.6%. Other bond funds to consider, though riskier, include Double Line Total Return Bond Fund and Loomis Sales Bond Fund. Next, don't ignore exchange-traded funds. Vanguard Dividend Appreciation is a favorite ETF for 2012. It tracks an index made up of companies that have increased dividends at least 10 years in a row. In tax-deferred accounts, opt for the Vanguard Intermediate Term Corporate Bond Index ETF. It favors high-quality corporate bonds over treasuries. And as always, check out the Kiplinger 25 on Kiplinger.com for our favorite no-load, actively managed bond funds. For Kiplinger's Personal Finance, I'm Jennifer Schonberger.